Hi there, Chris Pitcher from Redburn Atlantic. Nik, just maybe using Nuno's new targets in Mexico as an example. You talk about operating leverage and operating margin, but you gave us the sort of the relative gross margin of Guinness. Should you not be thinking more to sort of incremental gross profit? Because would he be compromising his Mexican business's operating margin by putting more Guinness on a truck as opposed to Johnny Walker? And is that mindset there, not focusing on the percentage margin? Thank you.
So I would say to you, I've now been here 9 months, and we're slowly chipping away at what has been a margin percentage, for lack of a better word, I'm going to say obsession at Diageo. Okay? So absolutely we're changing that, and it's moving to gross profit dollars. And one of the things I think that came up yesterday, and again, this is for the Remco to work through, but Debra and I are clearly focused also on absolute dollar free cash flow as opposed to an OCC there as well. So I think you'll hear more about that. But picking on Nuno, he seems to be the one being picked on today. So about a month ago, we were chatting, and he said, Nik, I think I have a big opportunity in Mexico. And I said, this was before Guinness, right? So I said, tell me more. And he said, I've just come back from the market. And I had just been there a month earlier. So he didn't know I had already spoken to the CFO and had dinner with him. And we talked about the fact that we just weren't playing in a huge amount of the profit pool in Mexico, in tequila, with brands that we have that we could play and win in, because it was going to be dilutive to our margin percentage in Mexico. And so I was hoping that what I had talked to the company about, and then the CFO, had played well back to Nuno, and well done, Nuno had passed. So he was actually talking about the fact that there's incremental dollars that we can go after. So absolutely, I think Debra and I are really trying to work on unlocking that. I'm going to embarrass Laura for a minute as well. So Laura came in, so Debra and I were in Miami, and in all the best, again, this goes back to, this was the culture, and this is the way they were thinking. And Laura came in, and we were talking about RTDs and an opportunity to unlock growth in North America, which is one of our 6 pilot markets that we're looking at, right? In terms of how do we really think about where is our right to win, both in RTD and RTS, and what's held us back, and what do we need to do as we think about investing in that going forward, right? And she started up with a question. She might not remember this. This was in November. And she said, so what gross profit margin do we want to achieve? And I said, it's not about what gross profit margin we want to achieve. What's the accretive gross margin dollar pool that we can actually bring in that we're not playing in today? And then the gross margin percentage is going to be the outcome of it. Now, if we're going into something new, which I think was also part of her question in all fairness, was how do we look at a 3-year plan when we think about not just the gross profit margin and the operating profit margin? Because, depending on the size and scale of what we might be launching, we might be using a toll packer, right? Well, clearly that's going to be some dollars that we're giving away, right? But clearly, until we get to the scale and size of what we want to do to bring that in-house, that might be the right choice. We will have to invest potentially incrementally in marketing and A&P as we want to launch that, right? So I think we're slowly chipping away at that. But I think the big unlock in my mind always comes when your incentives and your measurements and your performance all get linked in the right way. And that's what I think we're trying to achieve. Yeah.
Hi, Nik. Hi, Debra. It's Mitch Collett from Deutsche here. One question that might be very quick, and then one that's potentially a bit longer. Is there any chance you could tell us what you're targeting for the drop-through of the cost savings, or is that really a question that we should save for the summer? And then
save for the summer.
Okay, that one's quick. And then my second one, which is a bit longer, is on trade spend optimization. So would I be right to think that what you're looking at there is reducing the depth and frequency of your promotions? And if that's correct, how does that kind of fit with pressure on consumers, affordability, and I guess some of the pricing actions of some of your competitors in some of your bigger markets? And I guess I'm obviously thinking of the US there. Thank you.
Yeah, I mean, I'll take that one. Laura mentioned this. Consumer is certainly under pressure in many of our markets, and so it is something that we do look at pricing consumer back and understanding that dynamic from the consumer back. That being said, I wouldn't necessarily assume it's all about just frequency and depth of these promotions. And actually, that's where I think our revenue growth management tools have gotten a lot better. Because to be honest, that would have been probably something that in our tool, maybe back in the day, would have had. But I think we are clearly beyond that and looking at taking that much further so that we really look at, Nik had mentioned it's not just trade spend, it's also some of the commercial A&P and really looking at, call it our sufficiency through the line. So all the investments that go in at different points, right? Because you have everything from customer trade terms all the way through. So there's a lot there to unpack. But what's critical, and that's why I think Nik wanted to pull out, like we've got a few markets where we see the biggest opportunity. We're digging in there first, and we're also digging into and enhancing tools in there. But we'll take the learnings from those, and we can quickly scale that out as well. So more to come on that, but I wouldn't just think of it as kind of a depth and frequency thing.
Yeah, I'd just add to that, to Deborah's point. So I think firstly, let me just make sure when I talked about it, there's 7 markets. So it's North America, it's GB, it's Australia, it's Europe, it's GT. And when I talk about Europe, it's obviously we've got several divisions within or regions within continental Europe. So about 70% of the spend, when we look at our trade spend and our total A&P, comes from those markets. And we're looking at it end to end. So what I'd also add is with some of the tools that we've developed, and RGMX is one of the tools that we're working on, and GB and Germany are the 2 markets in which we're piloting today. So GB, that's why I was giving you some of those examples, because we've actually done the work with RGMX through that pilot on the total A&P bucket, and we're now expanding that into the trade spend area as well, right? So some of the examples that I gave you was around some of those promotions that might be around what's happening that's consumer facing, right? But when you actually look at the trade spend piece, which is in your gross to net, right? That's a big opportunity because that's probably where we've had a large amount of growth as well ahead of our NSV. Now, unfortunately, a lot of that just becomes paper money or funny money, right? And in some ways, actually, if you can just change your trade terms and conditions to net against that, to make it simpler, right, and more transparent, the better it is. But sometimes you don't want to do that because you want to look at your price listings as well and maintain that integrity. But where you do have an opportunity there is a lot of that is actually not going to the consumer. So it's not about the impact that it's going to have on the consumer promotion. It's actually what the customer is getting and how are we linking that to pay for performance with them, right? So I think there's an opportunity to either reduce or link it more for pay for performance on that as well, without impacting what you might be doing on the consumer-facing stuff, other than where it's just a negative gross margin return, right? So why would you be doing that, and why should the customer be doing that as well, right? Why can't we put it more into some of those gross margin-generating activities that are driving the volume through either promo, depth, or frequency, right? So I think we should separate out what is truly customer and what's consumer-facing as well.
I'm going to go to one online. So from Robert Ottenstein, I've got one for Debra. Can you give us an update on your US route to market optimization work, and are you seeing green shoots?
Yeah, I think, and I think Sally had given some updates at CAGNY as well. But look, I think our route to market, working with our distributor partners, going very, very well. I think feedback from distributors, we are seeing growth. I think Sally had used some examples of there in Florida. I think were her examples that she used at CAGNY of just what has happened in that market post that implementation. And we're still pretty early. I mean, this is one thing I would say, you're going to see green shoots on this just as you're getting in and you're going in and seeing more. We put more feet on the street in these cases, and so you're actually seeing people more face to face. But it is also over time as well, of really building out the portfolio, being able to respond quickly to what's happening in the market, being able to respond both competitively as well as take advantage of when you see something that's working. You know, I feel like I'm now repeating myself. When we see something that's working, being able to take that best practice and scale it quickly. I think that's one of the big opportunities that we have kind of as a company, is just how frequently we do those types of things. And I would say that's some of the early learning, but you know, clearly in the markets that we have focused on, I'm not going to list a lot of those just because it's competitively sensitive, but where we have focused on it, we're definitely seeing, and you know, and admittedly these things reinforce each other because we purposely picked markets where we saw opportunity, we've put people in, and then we've actually seen disproportionate returns from it, from both a market, but as well as some key brands as well, where we have focused that activity.
And maybe if I take one more from online as well, and then we'll come back to the room. So from Ed Monday, I've got two. So the first one is for Nik. In your 3 billion free cash flow target, is there a bare minimum of EBIT growth that is required before taking into account benefits from CapEx, lower CapEx, working capital gains? And then a second one, and I'm going to throw it to, it's probably Grania, and also we have Christina Diaz-Andino with us as well, our CMO. So one for you, that the two of you might want to have a think about. To what extent have the learnings from Guinness on driving cultural relevance and leveraging social media been actively shared across other brands in the portfolio? And what brand could be the next Guinness?
Sorry, I missed the last
What brand could be the next Guinness?
Oh, well,
Ooh.
hopefully a few.
Well, I'll answer Ed's first question
Yeah.
very quickly because he's going to have to wait until the summer till we lay that out. But what I would say to Ed is remember what I put out there. And we're looking at a variety of different scenarios in terms of how that recovery happens and the shape of it, both in terms of the industry and the macros. So I think clearly what we're trying to do in any of those scenarios is make sure for 26 we have that flow of 3 billion, right? So I'm not going to get into how much is going to come from CapEx and what's coming from EBIT growth and what's coming from maturing liquid, but clearly we'll give you some more color for 26. But the 3 billion is our floor under various scenarios, regardless of how the industry and or the macros perform. Grania.
Yeah, I can take this first half of the culture one maybe. So yes, we share the learnings very widely across Diageo. In fact, actually through programs like our Diageo Way of Brand Building, we actually have a module that's specifically on how to build brands with excellence and with relevance in culture. And obviously Guinness and some of our other brands that also have delivered great culturally resonant work are front and central in that learning and training for all of our marketing staff and indeed for our marketing agencies who also go through that programme. So, Christina, I don't know if you want to add anything on that or we're next.
I mean, look, Grania just, I think in her presentation explained, I thought very well, the way in which we approach brand building, which of course has evolved. So the principles that she has outlined for Guinness are applied across absolutely every brand at Diageo. So you may see multiple examples if you think about Johnny Walker, or if you think about the expansion of Don Julio in the rest of the world, how we are tapping into cultural relevance, even in aspects that you might think, they might not be culturally relevant. For example, I'll just give you an example that comes to mind, but we used Dia de los Muertos, which is, of course, the Mexican holiday, very important one for Don Julio, and we expanded that holiday truly in the rest of the world. As a global marketing leadership team, we awarded the best execution of Dia de los Muertos to India, because it was the market that really was able to take that way of portraying with the assets that were exactly the same as everywhere else and really create an engaging consumer moment that is remarkable. So I'm trying to illustrate the point, which is we apply those same principles across every single brand. You've heard from Debra and Nik talk extensively now about our agile brand communities. At the heart of that is a group of people who designs what are the growth drivers for each particular brand, and those growth drivers will be implemented across the entire world for which the brand matters. So we are making this operational, so I'm sure you're going to be seeing a lot more in this line of work.
I mean, I will add as a real compliment for Grania and Christina and the team, I mean, Guinness has really been our first, we talk about these ABCs, but the reality is they're much newer in some of these other brands. I mean, Guinness in many ways has been doing this and been piloting it for a long time through work that we had in the beer board. And so it is something that I would completely expect as we start to do more of this across more brands. I think there's big opportunity. And you just mentioned Don Julia would be my 2 cents that I would throw in to say, what's the next Guinness? Because I do think from a agile brand community, I think that that group is coming together as we're trying to take tequila around the world.
Thank you, Céline Pannuti, JP Morgan. So my first question, coming back on the disposal comments, I don't know, what has changed about the way you look at the portfolio? Obviously, there's been some disposal in the US, in India, where you guys are focusing more on premium. So what is changing that would lead to more bigger disposal? And then I'm thinking in an environment where many companies are trying to sell, where the environment's not great. Are you going to really maximize value? And how do you think about dilutions of earnings when already we have, you guys are constrained with cash? So I think, if you can look at the value creation equation from disposal and the idea behind it. My second question to round up on Guinness, and maybe, sorry, it's a repetitive question, but it feels like you have done an amazing job in where you were already big in Ireland, in GB. Your Continental Europe is 100 million of sales. It feels like it's the moment to go bigger and stronger there, and you're not doing that. So, if you could reconcile what is missing there. Thank you.
You want to talk disposals first again, or just
I'm happy to talk Guinness first. So I think Celine sent me a message yesterday, email, which I intentionally ignored. So she said she's going to ask me the question now here. So, it's good it's in the forum that we can all talk about it. Listen, I can't really, it's difficult for me to talk about what's changed, right? Versus what, as I've come in, I've been working alongside Debra and the board and really just stepping back to look at our businesses and our assets and our portfolio and how that links up to our longer term vision and strategy when we think about premium spirits growth alongside what we want to do, where we want to play in broader value pools within spirits, as well as what we're doing with Guinness and our beer portfolio. So I think I would look at it from an angle around, if that's our strategy and that's our focus, are there businesses or assets that don't necessarily give us synergies, right, with how we think about where we want to grow, right? So without saying more, I'd say that's the way we're looking at it, right? So clearly we see that as an opportunity as we think about our business and our assets as we look forward. You have a fair point around how do you then reconcile that from a value perspective, because clearly it's not like those don't bring value, and whether it's cash flows, EBITDA, et cetera, right? I think it's marrying that up with how does that also look from an angle of not what it's delivering today, but what it could deliver in the future with what investments need to happen in some of those businesses that could be quite capital intensive as well, right? So I think you've got to look at it in the whole equation of what's not just a value element in a given year, but what does it look like as you look at the next 5 to 7 years as well, particularly when you want to look at growth in line with your strategy. So that's the way we're looking at it, and that's the way we've discussed it with the board. And I think, the dog's barking.
I was going to say, we have dog barking
agreeing
up
with
here.
me with what I'm saying.
I mean, look, the only thing I would add to this is remember, I mean, Diageo, over our history, we have had, we have been active portfolio managers. I mean, when we got out of wine years ago, we have there's competitors out there just now getting out of wine. I think we've divested the tail brands, you mentioned the 19 and 19 in North America. A lot of these things have to do with time as well. Like, the India example is a really good example of when we divested the popular price brands there. At a certain point in Diageo's history, that would not have been the right thing to do as we were building up that Indian business and then looking at where the Indian consumer was at and where we saw it going in the next 10 years. So many of these things are a factor of time and what we're seeing in the industry. What do we think is going to happen over the next 10 years? What are we going to have to spend to really go after that opportunity versus maybe something else? So what I would say when we talk about being, rigorous, it is a matter of there's always choices, because in many cases there's opportunity in many things, but there's something, maybe a bigger opportunity in one place versus another. So I would just say, over time, all of these, it's important where you're at in time and where it's going.
It's still early days. I'm 6 weeks in the role, but I'll say we probably could share more in the summer. We are looking at Continental Europe. As to the point we made earlier, if I look at from a capacity perspective, could we double Continental Europe today? No. But when Little Connell comes on board and as we free up capacity within Guinness, we could actually grow. And that's why I say it's a multi-year journey. We see massive opportunity in Continental Europe, but it's a journey we've got to go on. But we'll probably be able to bring more color to it when we talk to you in August.
And remember, this is about more than distribution. I mean, when you build Guinness, it is about through the line and what you need to do to really launch into a market and to do that well. So you want fresh Guinness. You don't want to just put Guinness out there and not, have Guinness moving at the speed that it needs to have the best, freshest Guinness like you get here at Storehouse.
And it will come down to, again, choices there, because we're not going to have unlimited capacity to service all of it. And I'll come back a little bit to also, I think, what hopefully you've got a color of, but the fact that there is probably more opportunity as we think about asset-light models as well, right? To be able to expand without necessarily that same level of investment. So I think we look at it from both the angles of where would we prioritize in terms of where we would actually be, selling finished product versus what might be also a good further build out of the partnership model.
The only thing I'd add is, I think before in Continental Europe, we really only had one activation pillar, which was St. Patrick's Day, which was executed at real scale and with excellence through the line. Now with the Premier League, we actually have a scale activation partnership, which also makes, when you have the right distribution partners in place, with those right choices, you actually have that sort of playbook type model that I referenced earlier in terms of how we work with TPOs. So, again, alongside the sort of commercial side of things, the marketing side of things also has opportunity now.